Welcome to this explainer. I am absolutely thrilled you're here with us today because we are taking something that, let's be honest, often feels incredibly dense and just packed with jargon, and we're going to break it wide open. If you've ever stared at a massive stack of financial reports and literally felt your eyes glaze over, well, you are in the exact right place. Today, we aren't just staring at boring numbers. We're going to look at the incredibly elegant, logical filtering process that underpins how all financial statements are prepared. We're going to take that chaotic, raw data and filter it down step by step to uncover the absolute truth of a company's standing.
So think about this. How do you actually prove a business is truly healthy? You can't just look at how much cash happens to be in the register today, right? And you certainly can't just take the owner's word for it. To get to the real answer, the undeniable proof of health, you have to run those numbers through a highly structured funnel. And what this funnel does is strip away all the noise, layer on the actual realities of doing business, and ultimately reveal the exact financial position of the enterprise. It's honestly a fascinating journey from raw data to deep insight, and we are going to map out that exact funnel together right now.
All right, let's dive right in. Section 1, after the trial balance.
Now, every journey has a starting point. And in the world of financial statements, we're picking up the story just after all the foundational groundwork has been laid. To fully understand where we are, we just have to acknowledge what just happened behind the scenes. Think of this as the messy, chaotic precursor phase. First, step 1 is the journal. This is where every single transaction gets logged exactly as it happens. Boom, boom, boom. Then, step 2, the ledger. All those wild journal entries get sorted out into their specific accounts. And finally, step 3, the trial balance. This is where we simply list all those ledger balances out just to make absolutely sure our debits and credits actually match up. Now, we are speeding through this part because this is really just the raw material gathering phase. It's just data collection. The true magic, the actual financial statements, are prepared after this trial balance is complete. The raw data is finally ready. Now, we start filtering.
Which brings us to Section 2, finding your gross profit.
So here is the very first major filter in our financial funnel. This is where things start to get really insightful. The first true financial statement we run into is called the trading account, and it has one very specific, very vital job. It calculates your gross profit. How exactly does it do this? Well, by putting two massive numbers into the ring and letting them fight it out. On one side, you've got your sales. That's all the revenue coming in from exactly what you do. And on the other side, you have your cost of goods sold, the direct, unavoidable physical costs of creating whatever it is you're selling. You pit your raw sales directly against the cost to produce those goods. The result of that direct, head-to-head comparison? That's your gross profit.
And the reason this is so brilliant is that it immediately illustrates whether the core product itself actually makes any financial sense. I mean, think about it. If your cost of goods sold is higher than your sales at this very first stage, literally before we even look at paying rent or turning on the lights, your core product is fundamentally broken. Gross profit is the ultimate viability test. It strips away all the other distractions of running a business and simply asks, does making and selling this specific thing actually generate a surplus?
Okay, let's move along to Section 3, revealing the net profit.
So we know the product is viable, which is great, but we aren't done filtering yet. We've got to keep going down that funnel to find the actual bottom line. We take the gross profit we just calculated in the trading account and we carry it right over to the next stage, the profit and loss account, which you'll often hear called the P&L. Now remember, the trading account only dealt with the direct costs of the product, but businesses have overhead, right? The P&L is the filter that deducts all those other running expenses, your salaries, your marketing budgets, the rent, the admin costs. Plus, it also adds in any secondary additional incomes the business might have made outside of its core sales. So by taking the gross profit, subtracting all those overhead expenses, and adding any side incomes, the profit and loss account determines your absolute net profit or loss.
So the absolutely crucial takeaway here is this. While your gross profit tells you if your product is viable, your net profit tells you if your business is surviving. You can have an amazing gross profit, but if your overhead expenses are totally out of control, that P&L filter is going to catch it and you will end up with a net loss. The net profit is the ultimate measure of your company's operational success over a given period of time. And finally, Section 4, the balance sheet snapshot. Up until now, we've been looking at the flow of money. You know, sales coming in, expenses going out, over a period of time. But now, we completely shift gears. We are moving from a moving picture to a static, high-resolution photograph. This is the very definition of the balance sheet.
It presents your assets and liabilities, but the absolute most important part of this equation is that it's taken at a specific date. The trading and P&L accounts, they're like a video of the entire year's performance. The balance sheet stops the clock, freeze frame, right at this exact second. Let's say midnight on December 31st. What do we own and what do we owe? It doesn't show the flow of profit, it shows the resulting financial position at a single precise moment in time.
Let's actually walk through what this looks like in practice. On one side, we have our assets. That's everything the business owns that holds value. This includes your fixed assets like buildings and machinery, your investments, and your current assets, which is stuff like cash and inventory. Then, on the other side, balancing it perfectly, we have liabilities and capital. That's everything the business owes. We've got the owner's capital, we have formal loans, and of course, we have our creditors. And let me tell you, your creditors are the people who are definitely keeping very, very close track of exactly what you owe them on any given specific date.
And what is really interesting here is how a business actually chooses to order these lists. A balance sheet is typically structured using one of two very specific mental models: permanence or liquidity. If a company structures by permanence, they list the things that last the longest first. So on the asset side, they'll list those big fixed assets right at the top. On the liability side, they list capital first. They're doing this because they want you to see their long-term stability immediately. But if they structure by liquidity, they flip the whole thing upside down. They list what turns to cash fastest first, meaning current assets go right at the top. This tells a completely different story, focusing your attention immediately on their ability to pay off short-term obligations right here, right now.
Which brings us to our final thought for this explainer. The raw mechanics of accounting basically guarantee that your balance sheet is going to balance. But as we've seen through this entire filtering process, the numbers tell a much deeper story. Look at the balance sheet of your own company, or even a company you're just researching. It balances, sure, but the way it's structured, does it show a business genuinely built for long-term permanence, or is it really just surviving on short-term liquidity? Understanding that nuanced difference is the true power of financial statements. Keep that question in mind the next time you look at the bottom line. Thank you so much for joining me to demystify this process today, and keep learning.